Right, just when it seemed like everything was fine again, we're back up 10% almost, depending upon what index you're looking at. Yields were coming back down from where they opened up overnight. Inflation came in this morning better than expected, at least less than expected. But despite all that, the markets took a nosedive today, gave back a good chunk of what we got yesterday. And despite the latest CPI showing a small gain in March, stocks tumbled and investor anxiety jumped right back up again. So in today's market outlook, we'll unpack the reasons behind this market reaction, analyze key technical levels, and explore which sectors are showing some resilience among all this turbulence. Plus, we'll discuss the impact of these tariff announcements on future inflation levels and how that can impact market stability going forward. So let's go ahead and get started. Today is Thursday, April the 10th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, make sure you sign up for our daily Market Outlook email address by typing your email down here and click on this Sign Me Up box. You can also get notified when these posts are posted on the blog by clicking on subscribe up here at the top, or you can come down here to the bottom left and click on that bell. Come over here and click on this. It takes you to our Market Outlook live videos where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. Come down to the bottom, click this heart to like today's Market Outlook tweet. Click that to go to today's Facebook post, like it there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in, day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and start off. Take a look at the S&P 500 with the market forecast indicator. Sorry, I don't know. Again, the camera's still having issues, but we'll take a look here and see how the S&P did today, coming down a little bit giving back some of those gains from what we saw yesterday, dropping about 3.5%, which 3.5% would be that's a pretty significant down day. Let's see here. Let's go over here to the daily price moves. Just to give you an idea, now we've had a couple days like this before, but it seemed like nothing because we just had a 10% gain on SPY. Had a 10% gain, but that's a pretty good down day, even if it does look like nothing compared to one. We had another significant gap to the downside, gapping down 3% today at the open. That's the fourth gap lower of 2.5% or more in the past 6 days. So a lot of pressure coming overnight into the markets, and you can see down a little bit more already in the after hours here tonight. From 524 down to 520. One of these days I'm going to get a new camera here and it won't keep popping out, zooming out on me. It's a good thing I probably wasn't on Fox News. I was invited to be on Fox News yesterday morning, but they had obviously some things changed throughout the day, so they brought other guests on and pushed me back. And that's probably a good thing. If my camera kept zooming out during a hit there on Fox News, would be a disaster. But if we come back over here but I guess it would be Fox Business News, not Fox Business, not necessarily Fox News. With the rally, with this big rally and only a relatively small decline from that, the intermediate line is actually still going higher. So we have light green shading. But still below market sentiment. We're hardly bullish. The near-term line did not get above the 80th percentile today. Stopped just barely short of it at 79.4. The momentum line dropped from out of there. So as good as the short-term sentiment was yesterday, the point was to get the near-term line up here. And the last thing we want to see is what we saw last time, getting a near-term line to fail to get into the reversal zone. And we roll back over, cross back. Now with the intermediate line between the reversal zones, a bearish crossover, the near-term line below that would be bearish, again we're still below the 2.5% mark, below the 30-day moving average. So we didn't quite get the follow through, and we talked about that last night in last night's videos. It's too much too fast. We can't build on it. It would have been better had we spread this gain out over multiple days, so that you could build on it. So it's a little bit more solid. And you can see just how easy it is to reverse. I mean, it makes a 3.5% loss look very small because of how big it is. And so that's kind of the idea. Like, it was too much too fast. Like, this would have been a crazy down day today, but it just really wasn't. I mean, we're still above where we opened up on April the 4th, or right around where we opened up. We're well off the lows. So as bad as today was, and as bad as people made it out to be, like, I guess we were close to circuit breakers on the Dow or something. I mean, as bad as it made it out to seem, we're way off the lows. And we're a lot closer to the recent highs of this, this crazy range that we've been in. Really, since the open on April 3rd, we're closer to that high of the range than we are to the low of the range. So, puts a little bit of context there in terms of how bad today really was. The NASDAQ 100, same thing. We're a lot closer to the highs of yesterday than we are to the lows of a few days ago. The near-term line, again, stopping short of getting into the reversal zone. Intermediate lines rising, so we got light green shading, but still below market sentiment. And then you look at, like, the Russell 2000, same thing, stopping short. This one's a little bit worse short-term sentiment. Even though the momentum line yesterday had gotten above the 90th percentile, the near-term line, again, not getting far enough into bullish territory there. Its intermediate line is actually still in the reversal zone. So still, again, not bearish enough there. And then finally, if we take a look at the Dow Jones Industrial Average, you can see here that same thing. The intermediate line's above the 20th percentile, so we have the light green shading, but we're still below market sentiment. And the near-term line actually did close a little bit above the 80th percentile, but barely. I mean, it closed above it over here too. And again, not necessarily strong enough to make us think, oh, now we're going to get a bullish near-term peak. Obviously, whatever, the last peak was up here, so we'd have to get well above the 30-day moving average to get a higher near-term high. But the nice thing is we'd have to have a significant drop lower to get a lower near-term low. So even though we most likely will get a lower near-term high on all these indexes, we probably aren't going to get a lower near-term low on any of these the next time we get a near-term bottom. So that's actually a good sign, and I think we're probably going to be headed towards that near-term bottom sooner rather than later here. Let's take a look at the weekly chart. So let's pull this up here. And again, mainly because the near-term rally that we had, you got 10% gain in a day. So because it goes so far so fast, like we talked about last night, it's hard to get a good near-term run going because you've pretty much truncated a good near-term run into a single session. And now we're going to start a near-term decline, I think, as a result. You can see the candle. Again, you remember yesterday we were above where I thought maybe the midpoint would end up being, 53.39. Now we're back below it, but we're not that far below it. So there's still, pretty good potential. And next week will end up being a transition week. So the bearish momentum is stalled. Even though we might get a near-term run to the downside, again, I don't think we're going to get a lower near-term low. So the bearish momentum is stalled. Again, like I said, that the bearish momentum is stalled when a 3.5% decline, as big as that is like nothing compared to what we have been seeing. And again, we're a lot closer to the range of the high point of this crazy range than we are the low point. So that's what I mean when I say the bearish momentum has stalled. If you look at the 3 green arrow chart, you can see here that we have 1 green arrow now on the Dow, the S&P, and the NASDAQ 100. So we don't have the pink shading anymore. So we have the light green shading in the market forecast. We have the no pink shading here. But again, you have to have 3 greens to get the green shading, and you have to have it for multiple days before we can get that green line to go with it and for us to be bullish. But again, at least we're not as strongly bearish as we've been. If you take a look at the 2-line version, you can see we dropped back below the 8-day moving average. Yesterday we had jumped above both the 8 and the 17. So we crossed back below the 17 and the 8 today. The MACD is still below its average. The histogram is, obviously way up here. The stochastics is above its average. So again, we're probably, like, again, we'll probably end up flirting with 500 on any kind of near-term decline, but I don't think we get too far below it if we do. And then we'll, probably make another double-digit run. At least in this case, we didn't quite get to double digit. We came pretty close. On SPY, we did on this rally here, but it'll be the next one will be a lot slower than what we're seeing here, than what we saw yesterday. Let's take a look at some of these other oscillators. So we'll pull these oscillators up here. And you can see the DMI, again, is not bullish. It's still bearish, but it's not as bearish, right? We're down below 30 on the negative indicator. We're still easily below 20. So we're not anywhere close to being bullish. And we're still, like I said, it's not like we're not bearish either. We're still bearish. We're just not as bearish. We are still below 50, flirting with getting back below 40. We're still below 0, flirting with getting back below minus 100. So we'll keep our eyes on that. They're still both at bearish levels there. We still have a mature Ichimoku cloud. We only spent a day above the blue. We're back down below the blue and flirting with getting back below the green. Again, we're below the line by the time it turns the pink shading. So now we're watching for the cloud to turn green, right? If the cloud turns green, then we're getting a rally. And the question is, will we still be above the cloud when it does turn green, or will we still be above it by the time we get to the green shading, or will we be back below it? So let me show you what that looks like, because that's what correction, like we're in a correction now, and so when you get the correction, you get the rally, it turns green, right? So when you get enough of a rally, your cloud turns green there. So by the time we get to the cloud, are we still green? Are we still above it by the time we get to it? Because remember, it's plotted 26 days forward. So that kind of gives us an idea that we are kind of done with the correction. So obviously on this first leg, so you had our first leg lower down here, and then we had that move into March. Sorry, my cursor's not moving. But we had that move into March there, and then we had the green cloud. So by the time we got to it, we were in our second leg. So with that second leg, we got the pink shading. We started to go back up. We got the green shading. By the time we got to the green shading, we were actually still kind of a little bit above it, trying to make it out, like it looked like we were going to be okay, and then not so okay. Right, we're back below it, and again, by the time we got the the rally, green shading, by the time we got to the green shading, we were kind of above it, and we did get above it eventually, and ended up being just fine now. So that's kind of what we need to see that the correction is over with here. So that's what we're going to be watching. But first, we got to get the green shading. So we have to have enough of a run to the upside to break the bearish trend, because all of these moves were bullish moves. They just weren't strong bullish moves. This one was strong for a little bit of time, but they were bullish moves nonetheless. The bearish trend had ended, so we have to end this bearish trend and start a new bullish trend. And obviously, I don't think we're going to end the bearish trend in the next few days at the very least. Let's take a look at the Bollinger Bands and the Keltner channels. And you notice, again, that bandwidth is still very, very high, and we are flirting with getting back into the lowest quartile of the bandwidth. And you can see over here that, we are, the Keltner channels, we're not outside the Keltner channel, but the bands themselves are still significantly outside the Keltner channels, which, as long as they are, then we are prone to trading between them. So that's, keep that in mind, and eventually, as the momentum here pulls back towards zero, then the bands are going to move back towards the Keltner channels, and we can get back to, to get to a point where we can get a reversal, right? Because like I said, even in the, going back to 2022, those bullish runs that we had in between the multiple legs of that correction here, so you can see how we had some bullish momentum there. The bands had gotten back inside the Keltner channels. So same thing here. The bands had gotten back inside the Keltner channels, and we had some bullish momentum to the upside. So we're going to have a period here where we're going to have some bullish momentum. That would ultimately fail, but at least it'll be bullish enough to get the momentum back, the bands back inside the Keltner channels, and the momentum moving to the upside. But while they're not there, we still are prone, like I said, maybe during this next near-term decline, of potentially getting back below the Keltner channels briefly at the very least. Let's take a look at today's intraday range. And you see that, okay, well, it's a little bit of an inside day today. We traded a lower high and a higher low, gapping down. There's a common gap there, so we know we'll fill that gap sooner rather than later. It doesn't have to be tomorrow, but it'll be sooner rather than later here. I still think we'll probably test in the bottom of yesterday's range, maybe flirt with getting below it a little bit. Probably not, if we do get below these two lows, probably not go down too much further. The red line is dropping. It's got to get below 70. We've already hit 0 before on the green line. It doesn't have to hit it again. The range is still very high. It's set. That range is set for a while until one of these comes off. And it's not going to be the low anytime soon. So that range is set at a very, very extremely high level. So again, that's another reason why I think the low is set. Again, we might go a little bit lower on the next near-term decline, but not significantly lower because the range is already significantly large. Extremely large. Today's volume and trading range, if you take a look at those two, to see the trading range finally came back in after such an extreme the past few days. The trading range came back in there. Still above the average though, and that's, remember, that ATR is a really, really big number. And the volume is getting this off of its highs, but still it's more than 1.5 times. So you got the arrow down there. So when you look at those numbers in perspective, we're getting closer and closer to that 4% mark on the normalized ATR, and the volume you can see is over 100 million shares. It's been a while since we've been over 100 million shares, and you can't really look at this volume on a long-term basis because volume, as the price goes up, the volume naturally goes down because it costs more money to buy one share. But still, even we haven't been over 100 million shares since the banking issues that we had in March of 2023. And you can see the actual absolute ATR is up way higher than any time we had it in 2022, up to 20 points now. It's just an insane number. But again, it's even on a normalized basis, being at nearly 4% is also a pretty insane number, which again suggests that we are so extreme in these that it's we've pretty much got a low set in until we can get some relief on those extremities. We are still above 40, at least we're not above 50 anymore. We're still above 40 on the VIX. We're still above 100%, well above 100% on the VIX relative to the VIX 3M, and the VVIX is still at extremely high levels. So it's still well above 100 and well above 110 for that matter. So we're going to be susceptible to big moves, up and down. But still down, right? So we're still going to be susceptible to big down moves as long as that VVIX is as high as it is, and the VIX itself is as high as it is. So, and for that matter, the skew also being as high as it was. Let me pull that up here. Let me see where I have that. There we go. So let's bring up the skew. Sorry if I can get my cursor to work, because my cursor does not seem to want to work sometimes. All right. So the skew today ended up dropping down to 127, 14 points. So it was in the 140s previously. Here's actually the sentiment we'll take a look at here in just a second. But you can see we were at 142 yesterday, so back above the line. And that's kind of where we want to get to. I mean, we want to get above that line. If we're below that line, that means we're dropping, and we're dropping down to 127 today. The market's dropping, but that's the lowest level that has been during this decline. So that's a really good sign, bringing that average a lot lower. So when we get back above the average, we can go up for a while. So it's good to bring the skew down. But again, now we can see why the skew was so high at the end of last year, at the beginning of this year. We talked about just how unbelievably extreme it was. Well, now we know, right? We know what the market was protecting for. So there was a lot of smart money out there and protecting for some kind of move, and we got that kind of move. We talked about that too a lot during those periods of time, and now this was the move. This was the move that they were protecting for, this big 2+ standard deviation move. All right, now let's take a look at what's driving this price action. As you can see, gold had a significant move to the upside here, up 2.5% today. Clear risk-off move in gold. Even commodities struggled, but still outperformed. The DBC was down, but it outpaced all these equity asset classes. Even outpaced the dollar. And I mean, that's one of the big reasons why gold was so bullish, is the dollar just really tumbled. And bond yields went right back up, and that's not necessarily what the market wants to see. as to see bond yields going right back up. But that's what happened today. When you look at the bond market here, right back up to 4.39% after gapping down, moving up higher. Again, not down from where we were in the close, but still up from where we had open, and that's why that you see, like if you look at TLT here, which is what we saw in the other chart, that's why it went down so much, right? We gapped down and then continued lower. In fact, when you look at TYX, which is more, excuse me, I have to do the CGI, I forget. This is more in line with what you see on TLT. And you can see this one actually did go up 1% and went up about 5 basis points, and is actually getting a lot closer to 5%. So that's a significant move in the bond yields, and that's what the market's watching, right? It's above the 50-day average. The 10-year yield at least is above its 50-day average. It's at the top of the range that the Fed fund futures are in right now. So it's at a kind of a perilous level. Like, we don't want to get above that range. Not with all this, tariff news and everything else, going back. You can see a lot of that move, that the skew was so extremely high, was because we were closer to 4.5%. So the market's really concerned about the yields being as high. The stock market wasn't as concerned as the options market was early this year, late last year, but now the stock market's getting a little concerned, as we saw today, with the bond yields getting so high. So when you look at the correlation here let's see, did that not take? Try this again. There we go. So pull up TNX here and see its correlation here with SPX. There we go. So you can see it has, normally it's a positive correlation, but that correlation is turning more and more negative. It's almost negative on a 2-week basis, and the strong positive correlation it's had is peaking, and we're rolling back over. Again, it's the idea that as yields go up further from here, then stocks are going to keep going down. So that's why I don't think there's as much upside left to yields. So I don't think there's as much downside left to the stocks. And if yields were to pull back, as we saw, even just from gapping up and then dropping yesterday. The drop in yield, look how much of just that drop from the intraday, from the open, and even though it was we were still way higher than where it had closed the previous day, but just that drop there is a significant deal in terms of we got a 10% gain. Like, the markets want yields to come back down at least to the bottom of this edge and really start to reduce the odds that we're going to get that another cut. We have been pricing in a little bit better than the 50-50 shot of getting that cut at the next meeting in May, and that's, the Fed generally doesn't like to cut in May. They prefer to cut during a meeting where they're also they prefer to start a cycle, whether it's cuts or hikes. They prefer to start a cycle at a meeting where they're also giving projections as to how far they'll go. And this, because they don't want old projections to be out there when they make a change in policy, and that's what would happen if we did it here in May, which is just a few more weeks. But now you can see the odds are clearly, back up to 80% that they're not going to cut rates here. But again, if they start cutting in June, remember the best case scenario for stocks to have good, solid trends and returns going forward is for the Fed not to cut rates. So don't I know people come on TV and they talk about how the market's gonna love it, and the Fed's gonna start cutting rates, and they got the stock market's back. No, that's not. The Fed cuts rates when unemployment's rising or inflation is falling, or like we're deflationary. That's when they cut rates. So we do not want them to cut rates. That means that something is not good in the system. Now, having it on the table is good because of this idea that, rate cuts are great. So having it on the table and not using them is great. The Fed's there, but we don't need them. So stock market loves that. But once they have to start to use it, and you can see now for June, we have a 97% chance of a rate cut in June. And going to the next meeting in July, now that they will have new projections, they can do something in July. you have about 90 some odd percent chance of that cut, and then an 83% chance of a second cut. So, if we start into a rate cut cycle, and usually, like if we start to pick up the pace to the downside, they'll, use one of these meetings to cut 50 basis points more than just the 25, because, they don't typically spread out the cuts like they do the hikes, right? The hikes, they spread them out. But the cuts, they usually get done pretty quickly. The cut cycle is a lot shorter than the rate hike cycle is, for that very reason. And so, yeah, like if we're starting to cut here meeting after meeting, then that means we need it. And that's not going to be the best sign for markets. So we got May off the table. We need to get June off the table. And that's looking to be a lot more of a problem, right? With the 2-year yield, which, remember, that's the path that these rate cuts are on. If you take a look at the 2-year yield, remember, we're currently at 4.25, 4.5. The 2-year yield is way below that. So it's definitely pricing in a cut cycle now. And the 3-month tells us how, are we going to do it now at the next meeting? And we're still in between the 4.25. So it's jumped back up. So it's taken off the rate cut at the next meeting. And we'll see if it starts to tumble as we get through May and then start pricing in the June meeting. The spread is positive, right? Remember, it's positive now, which is a little bit of a problem. Remember, the markets like a negative yield spread. They don't like it to go back up. So if it gets back up to 200 basis points, 300 basis points, or in the case of the 10-year, 2-year, getting back up to 100 or 200 basis points here, that's not going to be what the market wants to see, right? If it gets up here to 200 plus basis points. So I mean, we're talking rate cuts. To get to that point, we need rate cuts, a cycle of rate cuts. It wouldn't be as much. Like the Fed's not going to cut to 0% again, most likely. But they'll cut enough to get to the spread up to 200 plus basis points. So they'll cut the lower end of it 200 basis points below where the 10-year yield ultimately would bottom out, would be the scenario that gets the spread to that point. The breadth was horrible today. So when you look at the McClellan oscillator, you'll see eventually here, we're still pretty negative, and now we are below the minus 500. So we talked yesterday we'd get below minus 500. We are below the minus 500 now. I still think we're going to be in a negative decline, so we're going to have more days. And you notice we're still not having extreme on that. So as bad as it is, it's not extreme. And if I take a look at some of these other breadth indicators that we like to look at, here, let's go over here. And you can see the number of stocks above the 50-day moving average, still at very extremely low levels. Not as bad as it was, but still below 100, right? 100 would be 10%. 100 would be 20%. So think of it like the market forecast chart. Like when you're below 100, you're in the oversold zone, that extremely oversold zone. So that's kind of where we're at. And we don't typically last that long in that level here, as you can see on past precedent. The number of stocks above their 200 was slightly below the 100 level, got back up above the 150s, which is 30%. We're still kind of around, again, right in between that, and still below the average. So we're still bearish, clearly bearish on the breadth. So with the rally we're getting, is not strong enough. The net new highs and new lows still very low. In fact, the 20-day average here is almost below 1,000. Again, we haven't had that since the correction, but that's about what happens during corrections. So if you didn't believe us, we're in correction before, pretty clearly now, the correction here. And then if you take a look at, remember yesterday was just a flip-flop of what had been dropping, bounced up the most, and what had been rising, or at least outperforming, dropped the most yesterday during the rally. So if I take a look at today, and just look at how we how things changed around today with kind of back to risk off mode. You can see we're back to where technology and discretionary are underperforming the markets. And in this case, they're joined down by energy stocks, which is a new participant, along with them. Communication services kind of matching the market return there. And then you can see your safety trades, which underperformed yesterday, outperforming. Staples actually up today. So, you know, if you're following Brandon's classes, you probably actually had a pretty good day today. Even if the broader market, led by these mega cap names, were down 3.5%. If you look at the mega cap names on this, are still just clearly underperforming, and not even close. Clearly underperforming here, but at the very least, we have a lot of light green shading. A lot of light green shading. We don't have green shading, green lines yet. We're not above moving averages. We don't have yellow lines. We briefly got yellow lines over here, like in Broadcom yesterday and Microsoft yesterday. Netflix had a bear tag yesterday as well. Nvidia had a bear tag. You can see light green shading and a yellow line. Let's see, maybe it didn't have the light green shading quite yet. Let's see what it had there. Nvidia. Give it a second here. Yeah, so it was light green yesterday. Got that bear tag, but now obviously still not bouncing. You know, not building on that. So it means we'll probably take another leg lower to the downside and flirt with the low point that we had in this range, and flirt with that oversold cluster there that we had a few days ago, that green dot, which generally is a kind of a reversal sign. So we're not out of the woods, but at least the bearish momentum has stopped, and you know, we can take a breath, we can gather our bearings, we can be able essentially to laugh off a 3.5% decline, which is crazy that we can laugh off a 3.5% decline, but you pretty much can, because the ranges are so big. You know, of the past week or so, that and we can make big moves inside of them, but we can make big moves inside of them and not get out of them, and that's the beauty, right? And that's what's probably going to happen until we, you know, get our next intermediate, like an actual bullish intermediate run, that most likely will fail, but at least it will be dark green shading and green line. We'll get a green tag again with double-digit returns again, and then we'll see, right? We'll watch for the failure or not. Remember, more often than not, it doesn't fail. More often than not, it bounces up to new highs. And that's ultimately what's, you know, this tariff and the inflation data, because that's a lot was talked about the inflation data today being so soft, but it was expected to be soft, so it wasn't a surprise at all. It was expected to be a lot lower than it was. When you look at the nowcast here, the numbers were small. It's off of it now because it came out today, but you can see it's expected to ramp back up in April, and that's the problem. It's like, okay, you know, after the the headline CPI has come back in, you see that 0.3%. So let's go over here and take a look at the actual headline and see what it dropped to on a year-over-year basis. So we'll change this to a change from a year ago. So down to 2.4%. So there's where we are at 2.40%. So it's expected. If I take a look at the percent changes on a monthly basis, it was actually negative, fell down 0.1, but it's supposed to get back up to 0.29. So this is, you know, kind of give you an idea. This is the month before was 0.21. So we're expected to jump back up into the higher levels of this range. So we're not, you know, that the inflation data being softer, you know, that you would think, oh, the market should have rallied on that. But we see why it didn't rally, because it's meant to be a very temporary reprieve. And more than likely, as these tariffs persist, because not all the tariffs came off, not all of them got the 90-day pause. So the more the rest of those tariffs persist, the more prices have the ability to stay relatively elevated, and that's kind of what the market doesn't necessarily. That keeps yields higher, and it keeps the Fed from cutting rates, and ends up being, and that's ultimately what ends up tipping us into instability going forward. The market, obviously, as we've seen, really does not like that. All right, that brings us to our trade idea of the day. So let's take a look at, it's actually on Starbucks here today. And Starbucks' chart looks exactly like everything else, right? Big dark pink shading and a red line, well below 30-day moving average, near-term line rising, most likely going to fail to produce a bullish peak, moving back towards the lower reversal zone. The intermediate line's rising, but still at very strongly oversold levels. So very, very similar. The big bearish candles on the weekly chart, but probably going to turn into a transition candle. A little different in that we're going to get a death cross right now. You can see the PPO is actually falling below zero there, but extremely low candle size that will most likely turn into a transition next week at the very least. Obviously, we have 3 red arrows on the chart. And the the stochastic is almost green as it's at 24.7. The MACD is rising, but still below its moving average, still way below. So we have some upside. The nice thing about Starbucks versus the rest of the market is there's a pretty good volume node at the bottom of this value area. We're still in the value area, and there's a pretty good volume node at the bottom of it. And obviously there's a pretty strong, the point of control is at the top of it. So you've got a nice little range, and we're stuck right in the middle between that. That's a sweet spot here. Looking at all the other indicators that were bearish but now are not, so very similar to the markets. Not as strongly bearish as it was on the not as strongly bearish as we were still bearish, but not as strongly bearish as we were on the RSI and the CCI. The Ichimoku cloud is still well below the cloud. We still have a mature bearish trend going. And then you look at the Bollinger Bands and the Keltner channels, and we had been well below the bands, but now we're we're at the upper end of the lowest quartile. The bandwidth is potentially forming a new 150-day high, and we are flirting with being below the Keltner channels. But again, I think the range is pretty set, and there's some upside to it. So what I decided to do here was to do an iron condor spread. So come out here to May, sell that low 20 delta on both sides. Selling the 95, selling the 75, buying one strike away for risk protection, and you can see it basically gives me a pretty decent reward with earnings coming up, a pretty decent reward for the risks that we have. But you see where the break evens are. I got room to go to the upside where I have some very strong resistance right at the break even, and my lower break even is down below where the lower volume node is. So obviously, breaking through either one of those nodes is going to be significantly directional in either direction. So we want to be out of the trade at that point. And so we have, but as long as we stay in between them, which they act as support and resistance when you're above and below. So staying in between them could be a very good opportunity, especially with the earnings coming out and the volume tapering off after the earnings. We have an opportunity to take advantage of that with this directional less trade. Non-directional trade with this iron condor and getting a pretty decent reward because of the extra volatility involved with its earnings coming up. All right, well, that does it for today. You heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all next time.